All right, welcome back, everybody, for another deep dive. And today we're going to be talking about investment strategy, but with a twist.
Ah,
We've got all this research here, and it seems like there are all these hidden factors, sort of off-market factors, that can seriously impact your returns.
just see.
And it's stuff that most people don't even consider. Kind of like those little details in a soccer match that nobody thinks about,
Yeah.
but can end up influencing the entire game.
Okay, yeah,
You
so I
know?
could see that.
Imagine one team gets stuck with a noisy hotel the night before, or there's unexpected weather.
Mm-hmm.
Suddenly the playing field's not so level, right?
Makes sense.
That's kind of what we're exploring today, those sneaky elements that can make or break your investing success, even if you think you've got the fundamentals down pat.
Yeah, it's amazing how often we can get so hyper-focused
Yeah.
on the technical aspects, like
Yeah.
all the charts, the algorithms, the
Yeah.
whatever it is,
Yeah.
and we totally overlook these
Ah.
external forces
Yeah.
that are just as powerful, if not more so.
And to really illustrate this point, we're going to be looking at the story of Michael Burry.
Oh, interesting.
You know, the big short guy, the one who famously predicted that 2007 subprime mortgage crisis
Right?
and made a fortune betting against the housing market. But here's the kicker. Despite his incredible foresight, his fund actually closed in early 2008,
What?
right before the real payoff came.
Wow.
So why is that?
Yeah, why?
Well, those off-market factors played a huge role.
I see.
And what's even more interesting about Burry is that he wasn't your typical Wall Street slickster. This guy was a doctor,
Really?
turned investor, incredibly introverted, and was later diagnosed with Asperger's syndrome. This
Uh-oh.
wasn't some smooth-talking, backslapping financier.
Definitely not the stereotype, huh?
Not at all.
So how did he even, I mean, it must have just been so different from everyone else.
Yeah, he was this incredibly dedicated researcher, you know, somebody who would just pore over thousands of pages of
Wow.
these complex financial documents that most people wouldn't even glance at.
Yeah, that takes a certain type of person to be that into the details.
And that's partly how he spotted the warning signs in the housing market that everybody else missed.
So he really wasn't afraid to go against the grain.
He was doing his own homework, not just following the herd. And it paid off, at least initially. He started out with a pretty traditional value investing approach.
Yeah, like the Warren Buffett style.
Exactly.
Finding undervalued companies
Yeah.
and holding on for the long term.
Yeah, he had a real knack for spotting those hidden gems.
Okay. But then what happened?
Well, he decided to short the housing market,
Oh, wow.
which at the time seemed absolutely unstoppable.
Yeah, everyone was riding that wave, not betting against it.
That's pretty gutsy. How do you even do that?
Yeah, how?
Well, he used these financial instruments called credit default swaps.
I've heard of those, but
Eh.
never really understood.
Well, think of it like insurance policies
Okay.
against the housing market collapsing. He was essentially betting that these mortgage-backed securities would go bust.
Yeah, that's where things start to get interesting.
Right. He's paying premiums on these swaps for years. His fund is performing poorly while the rest of the market is booming.
Yeah, everyone else is making a killing.
Yeah.
And he's just bleeding money.
It must have been incredibly stressful.
Imagine the pressure. Investors are getting restless,
Mm-hmm.
demanding their money back,
Yeah.
maybe even threatening lawsuits.
I bet he had to have an incredible amount of conviction to stick to his guns when everybody was doubting him.
Especially when it's your own money on the line. You're going against what everyone else is saying.
Yeah, I read somewhere that he'd blast heavy metal music in his office.
Oh, wow. Were
just to cope with the stress.
That's kind of funny. But I guess it makes sense.
Yeah. It really highlights the emotional toll that comes with independent thinking.
Yeah.
And going against the crowd, even when you think you're right.
Yeah, sure.
So eventually, as we know, Burry's prediction came true.
Uh,
The subprime mortgage crisis hit. And he made a fortune for his investors.
okay, but then what? What happened to the fund?
Well, this is where it gets even more intriguing. Instead of being grateful, a lot of his investors bailed.
Really? Why?
They were afraid he couldn't repeat it and worried about future instability.
That's crazy. So even though he was right, it still didn't work out for him.
This is a perfect example of that first off-market factor
Hmm.
that we were talking about, the impact of decision-making, both Burry's and his investors.
Oh, I see what you mean.
Even though he made the right call,
Oh.
his inability to effectively communicate his
Uh-huh.
strategy and manage those investor expectations ultimately cost him.
Wow, that's a tough lesson because communication is just as important as the investment strategy itself.
And it contrasts really sharply with someone like John Paulson,
Right.
who also bet against the housing market. But he framed his approach as hedging rather than doomsaying, which made a big difference in how investors perceived him.
Oh, interesting.
It's not just about the numbers. It's about how you present your case and manage the human element.
That's a really good point.
So, communication, managing expectations, it's all that's just critical as making the right investment calls.
I'm starting to see how these off-market factors
Yeah.
can really make or break you.
Burry's story shows that. Even a brilliant investor can stumble if they don't pay attention to these things. But it raises a question. Are there other, less obvious factors besides communication skills that can impact our success in investing?
You know, I think one of the most crucial ones, and this might be surprising, is having a stable income outside of your investments.
Wait, I thought the more you needed to make money from investing, the more successful you'd be.
It seems counterintuitive, right?
Yeah.
But think about it. When you're not relying on those investments for your everyday living expenses, it gives you a real psychological edge. You can ride out those market fluctuations without making rash decisions based on fear or greed.
So it's like having that financial cushion gives you the freedom to be more patient and disciplined.
Exactly, which in the long run leads to better outcomes.
That's pretty powerful. It's like having a safety net that allows you to think long-term and stick to your plan, even when the market gets turbulent. So far, we've got two really crucial off-market factors: decision-making and having a separate income stream. But how do we translate all these insights into practical
What can we actually do?
investment principles?
That's where we're headed next.
Yeah.
We'll explore how embracing simplicity, resisting temptation, and really understanding the true nature of the market can lead to more consistent investing success. Stick with us. You don't want to miss this.
So we've talked about how these off-market factors like clear communication and having outside income can really make a difference. But I'm curious about the investment principles themselves. What can we actually do to increase our chances of success?
You know, you often hear this phrase in the investing world. It's simple, but not easy. And I think that's a really important concept to grasp.
I'm a little confused. Simple, but not easy. Can you give me an example?
Yeah, absolutely. Think about the massive real estate boom in China over the past few decades. Tons of people made a fortune just buying property. Now compare that to the stock market, which also went up significantly. During the same period, far fewer people got rich from stocks, even though both markets were on an upward trend.
That's interesting. So why did real estate seem to create more wealth if both markets were performing well?
The key lies in that word simple.
Okay.
Picking the right stocks is inherently complex. Most companies fail, and even the ones that succeed don't always outperform the market.
Right.
Trying to consistently pick winners is incredibly difficult.
But with real estate, there's that classic saying, location, location, location.
Exactly. It seems much easier to grasp.
Yeah.
And even if you don't pick the absolute best spot,
Yeah.
you're unlikely to lose your entire investment.
It's true.
Bad decisions in real estate rarely lead to catastrophic losses, whereas with stocks, your investment can literally disappear overnight.
I see.
So in this case, the simpler approach led to greater success for a larger number of people.
So you're saying that in investing, sometimes the easier path, even if it seems less exciting or sophisticated, can actually be the smarter choice.
That's the counterintuitive wisdom here. The market doesn't care how much effort you put in or how complex your analysis is.
Right.
It only cares about the results. And sometimes the simpler path leads to better results.
Yeah.
Because it reduces the chances of making those costly mistakes.
That makes a lot of sense.
It's like those elaborate recipes with a million ingredients that end up being a total flop, while the simple classic dishes always seem to hit the spot.
Great analogy.
There's another fascinating aspect to that real estate boom in China.
Okay.
Most of the gains were essentially forced by the illiquidity of the market.
How so?
It's tough to quickly sell property, so people couldn't panic and sell when prices dipped. They were basically locked in to a long-term holding pattern, which, as it turned out, worked to their advantage.
So the very nature of real estate, its lack of liquidity, actually shielded investors from their own impulsive behavior.
Yeah, it's pretty remarkable. It really highlights a crucial principle. for successful investing.
What's that?
Resist temptation.
Okay.
Constantly checking stock prices, chasing the latest hot tips, trying to time the market.
Yeah.
These activities often lead to poor decisions and lower returns. The less you give in to those temptations, the better off you'll be in the long run.
Less action, more patience.
Exactly. It's like those studies that show the more you log into your trading account, the worse your returns tend to be.
It's true.
It's as if that constant tinkering just throws you off course.
We've talked about the importance of simplicity and resisting temptation. What are some other actionable principles we can take away from all of this?
Well, let's distill these insights into a few key principles.
Okay.
First and foremost, diversification is essential.
Diversification. Classic advice, but always worth emphasizing.
Absolutely. Spread that risk. Next, consider focusing on passive investing.
What does that mean?
That means investing in index funds,
Yeah.
in ETFs that track the overall market, rather than trying to pick individual stocks or outsmart the market.
So instead of trying to beat the market,
Yeah.
which is notoriously difficult,
Right.
you're suggesting we just ride the wave of overall market growth.
Exactly. Now, this next one is super important. Reduce costs relentlessly. Every dollar you pay in fees and commissions eats into your returns.
That's true. I'm probably guilty of not paying enough attention to those. It's easy to overlook those little percentages.
Yeah, but they add up over time. They do. And remember those real estate investors in China who benefited from being forced to hold on to their properties. That leads us to another critical principle.
What's that?
Stay consistent and patient.
Easier said than done, right?
It is.
Especially when the market is volatile and everyone's talking about the latest hot stock.
But that's where having a solid investment strategy and a long-term perspective comes in handy.
Okay.
Those short-term fluctuations are just noise. Focus on the big picture.
So we've got diversification, passive investing, minimizing costs, and staying consistent. What's the final principle?
This one is crucial. Only invest in what you understand.
Oh, that's good advice.
If you can't clearly explain how an investment works and why you're putting your money into it, it's probably best to steer clear.
No more blindly following the crowd.
Right.
Or getting seduced by those investment fads
Yeah,
that you don't really grasp.
Stick to what you know and what you're comfortable with. Now, here's the thing about these principles.
Okay.
They're simple to understand, but not always easy to follow.
Because there's always that temptation to chase those quick wins or get caught up in the frenzy of the market. It's really striking me is how powerful simplicity can be in investing.
Yeah.
It's almost like a secret weapon that most people overlook.
It really is. It's about recognizing that complexity often just masks risks, and it creates more opportunities for errors.
Right.
The market, in the end, rewards clarity, patience, and discipline.
And sometimes it's about recognizing that less is more. You know how people say, don't just stand there, do something.
Yeah.
Usually that's terrible advice. But in investing, it can be the key to avoiding those impulsive moves that can sabotage your returns.
I completely agree. It's about having that confidence to resist those urges, to not constantly tinker, to not chase every hot trend, to not try and outsmart the market. That's where the real challenge lies.
It's almost like finding that inner peace, that stillness.
Right.
Amidst the chaos of the market.
Exactly.
Yeah.
And trusting the process.
And that's where those off-market factors that we talked about can come into play. Having that outside income, mastering clear communication, those elements can really contribute to that sense of calm and allow you to make more rational decisions.
I think this deep dive has been incredibly insightful. I feel like I've gained a whole new perspective.
Me too.
On what it truly means to be a successful investor. It's not just about the numbers and picking stocks.
Yeah.
It's about understanding these deeper, almost philosophical principles that influence our behavior and ultimately shape our outcomes.
And it's important to remember that the real goal of investing isn't just to accumulate wealth.
Right.
It's about achieving your financial goals, whatever those may be, whether it's retiring comfortably, buying a dream home, or funding your children's education. Investing is a tool to help you reach those milestones.
Well said. So for everyone joining us today on this journey, keep these off-market factors and timeless principles in mind. As you navigate this complex world of investing, they might just be those missing pieces you've been searching for.
And as a final thought, I want you to consider this.
Right.
What are the off-market factors in your life that might be subtly hindering you, or surprisingly, giving you an edge.
Oh, that's a good one. How can we cultivate an environment both internally and externally that sets us up for success without needing to be a genius like Michael Burry?
That's definitely something to think about.
Thanks for joining us for this deep dive. Until next time, keep exploring, keep learning, and keep diving deeper into this fascinating world around us.